It's been a fascinating 24 hours in the market, starting yesterday afternoon with the release of the Fed minutes. Now, what makes the minutes themselves so interesting is the fact that there was nothing surprising on there. The wide-ranging views amongst policymakers was well communicated after the meeting itself, from those who think that inflation could turn into a problem and that tapering should begin straight away because their policy goals have basically been met, up to those who still think there's a lot more work to do on the labour market side, who think they should wait for tapering until early next year. And this very much came across in the minutes. The thing that was so fascinating about it is what's happened since. The markets seem to have become a little bit unstable in the aftermath of the release of the minutes themselves. We initially saw the dollar actually weaken slightly after the minutes, and then it started to strengthen quite considerably. We saw the stock markets actually pulling off in the aftermath of it as well, and that really carried through overnight in the Asia session and accelerated, if anything, early on in Europe. Losses across Europe earlier on in the equity markets were quite significant, 2, 3, 4%. So clearly, the shock waves were quite clearly being felt across various markets, which begs the question, if there was so little of new that came from the actual minutes themselves, why were we seeing such an impact on the markets? And I think this can be explained in a few ways. One of which is the fact that there has been growing uncertainty over recent weeks about the economy in the final quarter of the year because of the spread of the Delta strain. Firstly in China, which seemed to shake the markets a little bit, but then obviously in the US and in many other countries as well, New Zealand most recently going into lockdown. And I think that kind of growing uncertainty has just created some unease, basically, underlying in these markets. We're also in a very quiet period for the markets. The middle of summer, it is typically like this. But the Jackson Hole Symposium next week has put a lot of focus on this. So we're kind of in limbo at this point ahead of that. These stock markets were also at or near record highs. So I wonder whether it was almost a case of the Fed minutes were hawkish enough that it gave an opportunity for some profit taking some cash off the table, waiting for some dips ahead of the Jackson Hole meeting next week. And maybe these moves were just quite exacerbated by the environment which we currently find ourselves in. And it's easy to then point to something as being the reason behind everything, when actually it's a culmination of different factors which really feed into the weakness we've seen today, but also make me think that there's nothing overly concerning to worry about in the longer term. I guess we'll see how that pans out over the coming days. What I can see, though, is in the markets, we are starting to see a lot of these moves already being reversed slightly. So maybe that's a sign that the initial moves overnight and into this morning were a little bit overdone. Now, if we take a look at some charts, for example, we have cable here. Now, this shows the dollar strength that we have seen in the aftermath of these Fed minutes. Now, this is something that had been building prior to that. I think that's quite clear. We have seen some negativity and some weakness in the markets over the course of the week forming, and this was just simply accelerated earlier on today. Now, this is concerning for this particular pair because we've rotated off the 140 level, and now we're coming down and piling pressure back on that 200, 233-day simple moving average band, which provided support for the pair more recently, but it's actually traded over for quite a considerable amount of time. So a break below here could be a very bearish development, with the next obviously support then being those previous lows that we saw last month. So this is quite a significant development in this particular pair. The fact that we're seeing such dollar strength at this moment in time, if that continues, then that could lead to a breakout in this pair and could potentially be very bearish, very, very bearish indeed. The next chart we'll look at is gold. Now, obviously, this has direct correlation, not just with the dollar, but also generally the Federal Reserve and risk appetite in the markets. And what was really interesting with gold here is that after the Fed minutes that were deemed hawkish, although not necessarily even quite as hawkish as the commentary we've had from various policymakers over the last 2 weeks since the release of the jobs report, but it was deemed to be hawkish by the markets, which led to those moves. We did see the dollar strengthen, and we actually saw gold soften, which is a typical move that you would expect to see given those correlations. Then we saw that turn from hawkishness into risk aversion early on in Europe today, and that's where gold's safe haven roots appeared once more. So we actually saw gold from going lower on the day on dollar strength to actually rotating higher and pushing back towards those $1,800 levels. Now, it is worth noting that that risk aversion has subsided somewhat, which is why we've seen gold pull back once more, as well as other markets as well. But it's going to be really interesting to watch this space, because the fact that we've seen two different stories almost merging to form a narrative on the day, but both of which have very different ramifications as far as the gold market is concerned, and have this volatile impact on the yellow metal, is a really interesting one to watch, particularly given the risk aversion we've seen recently has seen gold push back through 1750 after that shock sell-off at the start of last week, and actually push back towards 1800. 1800, as you can see on the chart, is a big technical resistance level. The 50 fib level in particular, but just above here again, further resistance could be applied. So even if we break through psychologically significant $1,800 level, then in around the 1820 to 1830 level, you start to see quite a bit of resistance coming from prior highs. The key fib level 61.8, but also then the combination of moving averages, and a move above here would again be very bullish signal indeed. So some key technical levels to keep an eye out for, and I've only highlighted 2 charts here, but I could have brought up half a dozen which kind of told a very similar story. So I think these markets, while they are quiet right now, and you're expecting them to be quiet over the next week and a half, what we've learned today is just because they're quiet, it doesn't mean that the markets do completely stop altogether. And in fact, in these kind of less liquid, quieter markets, that's when you can sometimes see the most violent and volatile moves. And that's exactly what we've seen over the last 24 hours, which could make the next week and a half all the more interesting.